Here to help us dig into the numbers is Goldman Sachs' chief economist, head of global investment research, Jan Hatzius. Jan, always good to have you. You were a bit below in terms of where we came in. Just give me your take overall and how many jobs were added. Also, there were significant revisions the last 2 months.
Yes, the headline number for June was higher than we expected at 206,000. But if you look at the private sector number, which was meaningfully lower, and a lot of job growth accounted for by healthcare, once again, with some weakness in the cyclical sectors. Alongside that, some big downward revisions, as you said, an increase in the unemployment rate to 4.1%. All of that means it's a decent report, but it is a bit softer overall than I think widely anticipated. And this is why the rates market rallied on the number at least a bit.
Yeah, now we're seeing, 75% chance of a September cut. You mentioned softness. Is this what you want to see, though, for a soft landing, so to speak?
I think it's a soft landing kind of report. It, I think, will reassure Fed officials that the labor market has continued to rebalance. Wage growth also has come down. We're at 3.9% now for average hourly earnings. And the more important report is probably next week when we get the CPI for June in terms of what the Fed's going to do. But I think this does support the idea that they will cut relatively soon. And we continue to think September is the most likely.
The rate complex moving in reaction to some of the uncertainty on the political front here in the U.S. I know that you have been studying the tariff plan proposed by former President Donald Trump and the potential impact that might have on interest rate hikes.
Well, it certainly would have, if there is a significant increase in tariffs, it would certainly raise inflation in the in the near term. We estimate that a 10% across the board tariff would add a little over 1 percentage point to inflation in the year after it is instituted. And that could have implications for interest rates as well. I don't think it's going to have an impact on how the Fed is going to act over the next several months before the election. They're very focused on the economic data. They've said time and time again that political considerations don't come into it, and we take them at their word.
Is there a reckoning to come on the fiscal imbalances, whoever wins the election in November, in the early part of next year?
Well, I certainly think that over time we will need to see fiscal consolidation. We're looking at federal deficits in the 6% of GDP range, pretty much as far as the eye can see. There is no comprehensive plan on the table in terms of really bringing that down to more sustainable levels. Whether, at what point that occurs and at what point it really needs to occur, it's very hard to say. But over the next several years, I do think it is a really central part of the U.S. economic and policy outlook, how we get fiscal consolidation, and it is becoming more important as time passes and we see these very large deficits continue.